Merry Christmas. Again. I know I told you this morning to enjoy your families. To turn off the screens. To take a break. I was sitting here with a glass of wine, trying to do exactly that. But I can't ignore what just crossed my desk. I need you to put down the eggnog for a few minutes. I need you to step away from the noise and look at something very specific. The Chinese silver market just screamed a warning that's impossible to ignore. This isn't a prediction. This isn't a maybe. This is a mathematical fracture in the global financial system. Look at this number on your screen, $8,053. This is not a typo. This is not clickbait. This is the real, verified price of physical silver in Shanghai right now. Specifically, this is the settlement price from the Shanghai Futures Exchange. They closed at 18,145 yuan per kilogram before their holiday break. Now look at your broker app here in the US, $71.80. Do you see the problem? The difference is $927 per ounce. In the professional trading world, we don't call this a spread. We call this a broken market. I know what you're thinking. You think I'm making up numbers. So let's do the math together. Get your calculator. Shanghai price, 18,145 yuan per kilogram. Convert to dollars using the 7.006 exchange rate, $2,589 per kilogram. Convert kilograms to troy ounces. There are 32.15 ounces in a kilogram. 2,589 divided by 32.15 equals $8,055 per ounce. The math is undeniable. The largest manufacturing economy on Earth, China, values silver at $80. Meanwhile, the paper market in New York, where bankers trade digital promises, is pretending it's $71. Why is this terrifying for the banks? In a normal, healthy market, this spread shouldn't exist. If silver is $9 cheaper in New York, every bank, every hedge fund, every algorithm should be buying in New York, flying the metal to Shanghai, and selling it for a risk-free $9 profit. This is called arbitrage. It's the force of gravity that keeps global prices together. Usually, the spread is 50 cents. Maybe $1 in extreme volatility. But $9? That means the gravity is turned off. That means the arbitrage mechanism is broken. Why aren't the banks closing this gap? Why aren't they buying cheap silver in New York? There is only one logical explanation. They can't. They can't move the metal because the metal in New York isn't there. Or the logistics chain has completely collapsed under Eastern demand. We are looking at a market where the paper price and the physical price have officially divorced. Tomorrow morning, U.S. markets reopen for what we call Ghost Week. The low volume, illiquid trading days between Christmas and New Year's. You have a market with zero liquidity in New York. You have a $9 vacuum pulling the price higher towards Shanghai. Nature abhors a vacuum. That gap must close. China isn't going to lower their price. They have a shortage. So New York has to rise. We are staring at a massive gap up when the algorithms wake up and realize how mispriced they are. Why is the Shanghai premium so high? We have specific data from Chinese industrial sectors, solar and electric vehicles. They are panic hoarding metal regardless of price. Think about this. Why is China willing to pay $80? Why aren't they waiting for the price to come down? Why panic buy at all-time highs? Here's the key, this volume isn't coming from retail traders or hedge funds. It's coming from commercial hedging accounts. The factories themselves. We're witnessing an industrial run on the bank. And unlike a financial run where you just want your cash back, in an industrial run, if you don't get your metal, your factory closes. Your workers go home. Your company dies. That's why they're paying $80. Because the alternative is zero. First driver, solar photovoltaics. China controls over 80% of the global solar panel manufacturing. For years, Western analysts said, "Don't worry about silver demand. The companies will find alternatives. They'll use copper. They'll use less silver paste." That narrative just died. I have a report from the China Photovoltaic Industry Association released just before the holiday. It shows something critical: despite the high price of silver, silver consumption per watt has stopped falling. They've hit the wall. You cannot reduce silver content any further without sacrificing panel efficiency. But here's the kicker: TOPCon technology. The industry is shifting rapidly from old solar cells to new TOPCon and HJT cells. These new high-efficiency panels require 50 to 80% more silver than the old ones. So at the exact moment global mine supply is flatlining, the Chinese solar industry realized they need more silver per unit, not less. We're seeing verified reports from Jiangsu province, the heart of solar manufacturing, that factories are bypassing standard supply chains. They're not waiting for delivery from refiners. They're going directly to the Shanghai exchange and taking delivery of 15-kilogram bars. They're melting down investment-grade bars to turn them into industrial paste. This is desperation. This is a sector realizing that 2026 will be a year of famine. They're eating everything in the cupboard before the year even starts. But if solar was the only driver, we might manage it. The real panic, the reason this premium exploded to $9 this week, is coming from electric vehicles. We need to talk about the Samsung shock. Earlier this week, reports circulated about Samsung's new solid-state battery technology. These batteries are game changers. 600-mile range. 9-minute charge time. But here's the critical part: the anode isn't made of graphite. It's made of a silver-carbon composite. The specs are terrifying for the supply side. A standard EV uses about 20 to 50 grams of silver for contacts and switches. A solid-state EV uses up to 1 kilogram. 1,000 grams. That's a 20 to 50 times increase in silver consumption per car. Now connect this to China. China is the world's largest EV maker. BID. NIO. Others. Do you think they're going to let Samsung corner the market on next-generation battery tech? No. We're seeing massive block buys of silver originating from Shenzhen and Ningde, where companies are headquartered. These companies aren't building solid-state batteries today. But they're strategic hoarders. They know if they want to build millions of these cars in 2027, they need to secure the silver now. They're treating silver like lithium in 2021. They're buying the entire mine supply before it even comes out of the ground. When BYD buys silver, they don't buy 5,000 ounces. They buy 5 million ounces. And they're price inelastic. They don't care if it's 70 or 80. They care about locking up the supply chain to crush their competitors. So we have solar panic and EV hoarding. What does this do to inventory? Let's look at the Shanghai Futures Exchange warehouse stocks. In 2021, these warehouses held over 3,000 tons of silver. As of December 23, they're down to less than 800 tons. That's a 75% drawdown in visible inventory. Falling fast. But the registered warrants, metal available for immediate delivery, that's even lower. It's practically zero. This is why we have backwardation. Backwardation is a fancy word meaning, I will pay you more for metal today than for metal next month. Usually, future prices are higher to pay for storage. Right now in China, the spot price is trading significantly higher than the future price. The factories are screaming, "Don't promise me metal in February. I don't believe you. Give me the metal today." This backwardation is the heartbeat of a squeeze. It's the market telling you there's a physical shortage at the current price level. Now look at the West. Look at the COMEX. The traders in New York are looking at charts. They're looking at dollar indexes. They're looking at Fibonacci retracements. They have no idea what's happening on the ground in Jiangsu. They think silver is a currency. China knows silver is a strategic technology metal. The West is selling paper silver at 71 because they think it's expensive. The East is buying physical silver at 80 because they know it's cheap compared to shutting down a gigafactory. This is the great wealth transfer. Every ounce sold on the COMEX at 71 is being sucked up, refined, and shipped to a Chinese warehouse where it will never be seen again. So what happens tomorrow morning when Ghost Week begins? You have a market in New York with zero liquidity. Bankers are skiing. No inventory. The Asahi Vault has drained 1.4 million ounces. A $9 price gap with Shanghai. And now you know who's on the other side of that trade. It's not a speculator. It's BYD. It's solar giants. They won't stop buying just because it's Christmas. Their factories run 24/7. If a Chinese industrial buyer decides to hedge their January production tomorrow morning, they'll hit the COMEX ask button. Because the order book is empty, the price will skip from 72 to 75 to 78 in the blink of an eye. They'll close the arbitrage gap by force. Now here's the massive hole in this story. The question every professional trader is asking. If there's a $9 profit on every single ounce of silver, why isn't anyone taking it? Think about how Wall Street works. These are the greediest, smartest, fastest institutions on the planet. They have supercomputers designed to scalp fractions of a penny in microseconds. If they see an asset trading at 71 in New York and 80 in Shanghai, their biological imperative is to close that gap. They should be buying every bar in the COMEX vaults. Chartering cargo planes. Flooding Shanghai with silver. It's literally free money. It's a risk-free trade. So why is the gap getting wider? Why has it gone from 2 to 5 to now 9? The answer is terrifyingly simple. They cannot move the metal. We're witnessing a catastrophic breakdown in the physical logistics of the silver market. The arbitrage mechanism, the engine that keeps global prices in sync, has seized up because the fuel is gone. You can trade paper contracts in milliseconds. But you cannot teleport a 1,000-ounce bar of silver. You have to physically source it. Load it. Insure it. Fly it. And right now, that supply chain is broken. We've spoken to sources in the logistics industry. People dealing with secure air freight out of London and New York. They're reporting a complete blockade. Not that planes aren't flying. But that the metal isn't showing up at the loading dock. The bullion banks are trying to source metal to execute this arbitrage trade. They're calling vaults. They're calling refineries. For the first time in decades, they're being put on a wait list. Refineries are saying, we're booked solid for 6 weeks. Vaults are saying, we need 48 hours to locate that specific bar serial number. Locate the serial number. In a digitized modern vaulting system, you should know exactly where every bar is down to the millimeter. When a vault operator tells you they need time to locate your metal, it means one thing. The metal isn't where it's supposed to be. Or worse, it's been rehypothecated, loaned out to someone else, and they're scrambling to find a replacement before you notice. This brings us to the smoking gun. The hard data proving Western vaults are being drained of their last deliverable ounces. While everyone was distracted by holiday shopping, the COMEX released its inventory report for December 23. This is the last official data point before the Christmas break. It is absolutely critical that you understand what it says. In a single day, the Asahi refining vault in New York saw a withdrawal of over 1.4 million ounces from its registered category. Let me repeat that. 1.4 million ounces gone in 24 hours. You have to understand the difference between eligible and registered. Eligible silver is just sitting there. It might be owned by a private collector or family office. Registered silver? That's the lifeblood of the exchange. It's metal that's fully warranted and available for immediate delivery. It's the for sale inventory of the entire market. When you see 1.4 million ounces leave the registered category at Asahi, plus another 600,000 ounces leave the JP Morgan vault, plus another 200,000 ounces leave the CNT vault, all in the same day, you're watching a bank run. You're watching the smart money rushing for the exits. These entities, and we strongly suspect they're linked to the Asian industrial buyers we discussed, are not playing the paper game. They're not hedging. They're taking possession. They're backing a truck up to the loading dock in New York, loading it with 1.4 million ounces of physical bars, and driving away. And this explains why the arbitrage gap won't close. The inventory that banks would use to ship to China is already being taken by the Chinese. It's a paradox. The very demand driving the price to 80 in Shanghai is also sucking the inventory out of New York, making it impossible for banks to execute the arbitrage that would lower the price. It's a death spiral for the COMEX. The more the premium rises in Shanghai, the faster the metal leaves New York. The faster the metal leaves New York, the less liquidity there is to manage the price. The less liquidity there is, the more the price disconnects. We're also hearing rumors from floor traders in London. I want to stress these are currently unverified reports. The LBMA, the London Bullion Market Association, is facing administrative delays in processing large-scale allocations. Usually, if you have an unallocated account and ask for your bars, it takes a few days. We're hearing delays stretching into weeks. If London is out of metal, the game is over. London is the main hub. It's the vault of last resort. If the London float is gone, the COMEX is just an island. It's a paper market trading a derivative of a ghost. This is why Ghost Week starting tomorrow is so dangerous. We have a market in New York that's been hollowed out. Registered inventory is plummeting to historic lows. The float, actual available metal, is razor thin. Tomorrow morning, the electronic markets turn back on. You have a $9 incentive for anyone with physical metal to sell it in Shanghai. But there's no metal left to ship. So what happens if you can't ship the metal to close the gap? The only other variable that can move is the price. The New York paper price must rise to meet reality. It cannot stay at 71 when the physical world is transacting at 80. The math simply doesn't allow it. The banks are trapped. They're short paper contracts in New York. But they've lost control of the physical inventory. They're like a poker player who's bet the house on a bluff. But the other player just showed a royal flush. The other player is China. And China isn't bluffing. They're taking the chips. They're taking the table. They're taking the metal. We're witnessing the end of the paper price era. For 50 years, New York told the world what silver was worth. Today, that authority has been revoked. The price is now being set on the loading docks of Shanghai. New York is just a lagging indicator. Tomorrow morning, December 26th, we're about to witness a collision between two unstoppable forces. The liquidity vacuum of Ghost Week. The price magnet of the $9 Shanghai premium. Usually, when these forces collide, you get volatility. But this time, because the physical bridge is broken, we're likely to get something much more dangerous. A super gap. Let me explain the battlefield. Tomorrow morning, 90% of senior traders at JP Morgan, Goldman Sachs, HSBC are on vacation. Their trading desks are being run by skeleton crews, junior traders, and automated algorithms. The order book is paper thin. On a normal day, there might be 500 contracts for sale at 71.50. Tomorrow, there might be 50. This is the liquidity vacuum. It takes very little money to move the price a very long way. Now enter the high-frequency trading algorithms. These bots don't know it's Christmas. They don't know Asahi is empty. They only know math. The algorithm sees asset A, Shanghai, 8,053. Asset B, New York, 7,126. Instruction: buy asset B until price A equals price B. Usually a human would intervene. A human would say, wait, we can't ship the metal. Don't buy. But the humans are skiing. The algorithms are running on autopilot. Tomorrow morning, when Shanghai market opens and confirms that $80 price, New York algorithms are going to try to close the gap. The only way they know how. By bidding up the paper price. Here's how the squeeze happens, step by step. The trigger: a Chinese industrial hedger places a large buy order. They need metal. They don't care about the holiday. The vacuum: this buy order hits the COMEX. Because it's Ghost Week, there are no sellers at 71.30, no sellers at 71.40. The slip: the order slips instantly to 72 just to fill the first few contracts. The algo chase: HFT bots see the price jump. They see the $9 premium. They calculate arbitrage opportunity. Suddenly, massive buying pressure hits an empty room. The price doesn't tick up. It gaps. It skips 73. It skips 74. It prints 75 within minutes. This is what we call an air pocket. Because the physical arbitrage shipping is broken, the only way to close the spread is for the paper price to teleport upward. But it gets worse. We have thousands of call options open at 72 and 75 strikes. The banks sold these options to speculators. If the price gaps to 75, the banks are offside. They're losing money. To protect themselves, Delta Hedge, the bank's automated risk engine, has to buy futures. As the price rises, the banks are forced to buy more. Buying more pushes the price higher. That forces them to buy more. It's a feedback loop from hell. And it's happening in a market with no inventory to slow it down. You might ask, won't people sell at 75 to take profit? Who? The miners aren't selling. They're holding back supply. The Chinese aren't selling. They're hoarding. The vaults are empty. The only people who might sell are retail traders. But are you going to sell your silver at 75 when you know it's trading at 80 in China? No. You're going to hold. You're going to wait for 80. The sellers go on strike. The buyers panic. The algorithms chase the ghost. So here's what you need to watch for tomorrow morning, December 26th. Do not look at the news. Look at the spread. If New York opens flat at 71, it's a trap. The explosion is just delayed until volume returns on January 2nd. But if New York opens at 73 or higher, the squeeze has begun. If we break 72.50 in the first hour of trading tomorrow, the air pocket is active. We could see a move to 78 before the lunch break. The market is trying to tell you something. It's trying to tell you the discount window is closing. The $71 price is a lie. The $80 price is the truth. And the lie is about to be violently corrected. Let's assume the squeeze happens. Let's assume Ghost Week closes the gap and New York wakes up at 80. The skeptics will tell you, that's it. The bubble is done. Sell everything. They're wrong. They're fundamentally misunderstanding what's happening. $80 is not the ceiling. It's the new floor. What we're witnessing isn't just a trade. It's the end of an era. It's the end of the Western discount. For 50 years, New York and London determined the price of silver. They used paper contracts to keep prices convenient for Western banks. But today, with Shanghai trading at 80, that era is officially over. The pricing power has shifted east. China isn't trying to manage the price. They're trying to secure the metal. Once New York capitulates and matches the $80 price, the suppression mechanism is broken forever. To understand why the price goes higher than 80, you have to understand the psychology of a CEO. For the last 30 years, global industry ran on just-in-time inventory. If you were Samsung or Tesla or a solar manufacturer, you didn't hold silver. You trusted the market. You believed if you clicked buy on Tuesday, the metal would arrive on Wednesday. But what happens when the premium hits 9? What happens when the vaults run dry? Trust evaporates. We're moving from just-in-time to just-in-case. Every industrial CEO looking at this $9 spread is thinking the same thing. If I don't buy 6 months of inventory right now, I might not get it later. This creates a hoarding super cycle. It doesn't matter if the price is 80. If you're building a $50,000 electric car and it needs $80 worth of silver, you pay it. If silver goes to $150 and that car needs $150 worth of silver, does that kill demand? No. It adds $70 to the cost of a $50,000 car. It's irrelevant to the final product but critical to its function. Silver is inelastic. In an inelastic market, when confidence breaks, the price doesn't double. It adds a zero. Let's talk about the banks. The paper masters. Their entire game relied on one bluff. If you buy futures, we can deliver the metal. The $80 Shanghai price calls that bluff. If the banks try to short silver at 80 to cap the price, the arbitrage bots will just buy their paper, take delivery, and ship it to China. The banks cannot suppress the price anymore. Because they'll bleed physical metal instantly. This means the cap is gone. The artificial ceiling that kept silver below 30, then below 50, has been removed. We're entering a phase of pure price discovery. In price discovery, the price has to rise high enough to do one of two things. Destroy demand. Make it too expensive for Samsung to use. Create supply. Make it profitable to open new mines. Let's run the numbers. To destroy demand, solar and tech need silver. They can't switch. Demand is sticky. To create supply, it takes 10 years to permit and build a new mine. Even if silver hits 200 tomorrow, no new supply comes until 2035. So for the next decade, the price has to do the heavy lifting. $80 is just the wake-up call. $125 to $150 is the equilibrium needed to balance the deficit. Here's my forecast for the new reality of 2026. We will see a bifurcated market dissolve into a unified bull market. Right now, we have two prices, 71 and 80. By January, we'll have one price, 80 plus. Once that merge happens, Western investors, pension funds, retail stackers, will realize the shortage is real. They've been sitting on the sidelines afraid of the bank smackdown. When they see the banks are powerless. When they see 80 holding as support. Investment capital will flood in. We have industrial panic, the floor. Logistics breakdown, the squeeze. Investment FOMO, the rocket fuel. This is the recipe for a move that makes 1980 look like a warm-up. But there's a danger here. Not a danger of price crashing. But a danger of psychology. When silver hits 80, your brain will scream, it's too high. Sell. Take profits. You're conditioned to think 30 is high. You're conditioned to think 50 is the top. You have to rewire your brain for the new reality. In a world where the dollar is dying and China pays 80 for strategic metal. 80 is cheap. 80 is the new 20. If you sell at 80, you're trading a scarce strategic asset for a depreciating paper currency right at the moment the asset is about to go vertical. You're selling your ticket on the lifeboat just as the ship starts to sink. The squeeze is inevitable. The gap will close. The price will re-rate. The question is not if. The question is, how do you survive it? How do you navigate a market that moves $5 a day? How do you avoid getting shaken out by volatility? How do you protect your stack when dealers run out of inventory? I'm going to share 3 specific strategies for the retail investor. Strategy 1: Ignore the dollar price. The biggest enemy you face right now is your own brain. Your brain is anchored. For years, you've been conditioned to believe 30 is expensive and 50 is the moon. If we gap up to 80 next week, your brain will scream, "Sell, take the money, it's a bubble." You must silence that voice. Understand, the dollar price is a lie. If you sell silver at 80, what are you getting? Fiat currency. A currency the Federal Reserve just admitted they have to debase to save the debt market. A currency China is actively dumping. If you trade a scarce strategic asset for a depreciating liability, you aren't taking profit. You're jumping off the lifeboat and swimming back to the Titanic. Stop looking at the dollar price. Start looking at the gold-to-silver ratio. Right now, it's around 60-1. Gold is approximately $4,200. Silver is approximately $71. Historically, in a true monetary reset, that ratio compresses to 15-1. Until silver hits 1/5 the price of gold, it's fundamentally undervalued. Do not even think about selling until that ratio screams at you. 80 is not the signal. Strategy 2: Embrace the volatility. Next week during Ghost Week, the volatility is going to be nauseating. The liquidity is so thin. We might see a flash crash. We might wake up Tuesday and see silver down $4 in a single minute. Some algo dumped a block of futures. The media will scream, "Silver crash, bubble burst." Your spot price will flash red. Ignore it. Remember the Shanghai price. Remember the industrial panic. If spot price drops to 68 on your screen, ask yourself, can I actually buy physical metal at 68? Go to online dealers. Call your local coin shop. I guarantee they won't be lowering prices. They'll be raising premiums. They know the physical market is broken. If the paper price crashes, it's a gift. It's the fake price diverging from the real price. Do not get stopped out of your position by a paper game. If you hold physical, you're immune to the flash crash. You hold the ounces, not the contract. If you hold miners or ETFs, have conviction. The paper price must eventually reconnect with physical reality. 80+. Strategy 3: Secure the ounces now. This is the most practical advice I can give you. As the arbitrage gap widens, metal flow from west to east is accelerating. We're hearing that major US dealers are already running low on 100-ounce bars and sovereign coins. Eagles. Maples. There's a very real possibility that in January 2026, the buy button disappears. You'll go to a website and everything is out of stock. Pre-order only. 6 to 8 weeks delay. When that happens, the price on screen becomes irrelevant. It doesn't matter if spot is 80 or 100 if you can't buy any. If you have cash on the sidelines, do it now. Do not try to time the dip next week. Do not try to save 50 cents. Secure the ounces while they're still available for immediate delivery. Because once Ghost Week gap hits and headlines break about the $80 Shanghai price, the retail stampede will clear out remaining inventory in 48 hours. I want to close with a thought about why we're doing this. It's not just about making money. We're living through a historical pivot point. For 50 years, the Western financial system used paper derivatives to suppress the price of real assets. They kept silver cheap to subsidize their industries and their currencies. But the East, China, India, Russia, the BRICS, has called the bluff. They're draining the vaults. They're demanding physical delivery. They're forcing the world back to a system based on reality. The price of silver will go wherever it needs to go to make that reality happen. $80 tomorrow. $150 this year. $300 before the decade is done. The number doesn't matter. What matters is this. You now understand why it's happening. You understand the mechanics. You understand the timeline. You have time to prepare. Do it now.